And Mike McGlone, senior commodity strategist at Bloomberg Intelligence, has recently suggested that Bitcoin's underperformance compared to the stock market may be a warning sign for investors. McGlone notes that Bitcoin has declined compared to the NASDAQ 100 stock index since its 2021 peak and April bounce. This waning performance may presage rising headwinds, not only at Faraday and for Bitcoin, but also for the broader crypto market. McGlone stated, if Bitcoin truly is the fastest horse in the race, as some consider it to be, then it should logically be outperforming in an everything bull market. However, that's not the case. And notably, McGlone points to the most aggressive liquidity pull from central banks in history, which may be a significant factor in Bitcoin's underperformance. The Federal Reserve still citing in 3Q, despite the producer price index finished goods gauge at minus 3.1% and dropping from 2022's 18.3% peak at its fastest pace and since 1948, which may be part of what underperforming Bitcoin is, snipping out, according to McGlone, on a one-year basis to August 1st. Bitcoin is up just over 20%, similar to the NASDAQ, yet that the crypto's volatility is about 2 times greater. McGlone believes that Bitcoin's underperformance may be a warning sign for the broader market. The fact that Bitcoin is not outperforming as it should be in an everything bull market could indicate that more significant market issues are at play, particularly in the face of aggressive liquidity pulls from central banks. In a statement shared with News BTC, Luke Striders, the chief commercial officer at Deribit, a prominent cryptocurrency derivatives exchange, has recently stated that the Deribit volatility index for both Bitcoin and Ethereum is currently trading at an all-time low. This is a significant development, especially since the devol for ETH is trading below the devol for BTC, which is a rare occurrence and may have been caused by the activity of a single large trader, commonly known as a whale, in its network. Despite the current low levels of volatility, Luke Striders highlights that the market is anticipating considerable upswing in volatility shortly. This expectation is driven by the upcoming ruling on the BlackRock spot exchange-traded fund and the approaching Bitcoin halving. And Striders notes that Deribit has been observing signs of these expectations in the market, such as the significant steepness of the term structure, with June 24 trades at approximately 750 and the enduring call skew. These indicators suggest that the market is anticipating increased volatility and potential price movement shortly, despite the current low levels of volatility. And before that question, ask, APG ruled, you maybe imagine in the entire opportunity to diving a single major customer attention payment. According to the new buy, all of it will be used to help with cryptocurrency, potentially increasing demand and driving up prices. On the other hand, if the ruling is not approved, it may lead to a temporary drop in prices and increase volatility. The approaching Bitcoin halving, which is expected to occur in 2024, is another factor contributing to the anticipation of increased volatility, according to Striders. And the halvening is a significant event in the Bitcoin network that occurs roughly every 4 years, where the block reward for Bitcoin miners is cut in half. And this tends to reduce the supply of Bitcoin on the market, potentially driving up prices and increasing volatility. Despite the current low levels of volatility, Striders suggests that investors and traders should remain vigilant and prepare for potential price movements and increased volatility in the cryptocurrency market. At the time of writing, BTC is trading at $29,100, representing a slight increase of 0.8% in the past 24 hours.